Justin, what options do you plan on entering and when for this upcoming June cycle?
Absolutely. So I'm keeping an eye on GME and keeping an eye on Bobby, so Bed Bath and Beyond. My guess is that I already have probably my long-term volatility position already established. That's to say, I've got my some 950 calls and I've got some 80 calls for Bobby as well. I think what I'll do is towards the end of this week, I'll start picking up, or that's when I anticipate entering my GME position, is no later than the end of this week, maybe the beginning of the week thereafter. Although I definitely want to make sure that I start buying in probably around Wednesday or so, just in case it starts covering early. I think back to what happened in terms of November, where I think 2 or 3 days earlier they started covering early and things ran for that. So anyways, that's kind of like my thinking on that front. Josh?
Well, what actual options are you looking at right now?
So that's good. I'm still trying to figure it out, but I think in terms of like three tranches. I think the first tranche, which I already kind of have, is it's kind of like my MOAS protection, both for Jimmy and for Bobby, where it would be like whatever the furthest dated I can get with the highest strike. So in GME land, that's going to be, or actually in both GME and on Bobby land, that's the January 2023 contract with a $80 strike for Bobby and a $950 strike for GME. Now, the reason I feel comfortable doing that is because I can sit in front of my computer all day and actively babysit these positions. So in other words, that if there is a run up and IV, spikes on that, to the smile or through IV running up, the options will greatly appreciate. I can cash out, and I've also got a few like kind of like predetermined limit orders to set in. I mean, I'm not as sophisticated as PiFi by any stretch of the imagination, but I can say, okay, well, look, if you have a run, it's going to run by this much. Then if I have a limit order for that amount, if it runs up, then yeah, sure, I might have left some money on the table, but I've clawed back all of my entry costs, which means that I kind of view it as playing with the house's money, and so it's a little easier to sleep at night. Plus, when I first entered my 950 call positions in Jimmy, like I got in when Ivy was really really high. I'm like I've been averaging down. Don't get me wrong, but I'm still licking my wounds on
Yeah.
those contracts. Just to be clear.
Oh, you were buying those what at like $25 or something like that.
Yeah,
Like
like 2000.
something retarded. So
Yeah.
me personally, I apologize. My face is chubby. I got my wisdom teeth taken out yesterday, so it is a bit harder for me to talk, and I might have a lisp. But that is not because I was behind the Wendy's dumpster yesterday doing things
Yeah.
that Mama Bird would not be too proud of. But anyway, I'm looking at. We have been talking about that. We do expect it to go down. I do have so right now I don't have a lot of cash on hand because I have a lot of puts on both GME and the market. I plan on closing the puts on GME going no later than Friday, but I have quite a few, so I'm gonna start closing those slowly this next week. Most of them are pretty up because the market's really taken shit the bed. I'm hoping market's down going into next week. I'm pretty sure it will be as the Fed. They'll probably raise another 50 basis points. Just nothing good seems to be coming out of the markets right now. So that's pretty much what I'm doing for entering this cycle. This is the most excited I've been about a cycle ever, just because everything is becoming very accurate. If you're watching PiFi, I really haven't been too often, but Justin has. But the accuracy at which the Reddit community can start predicting these price movements is getting very, very impressive. And
Yeah,
with
just or
that,
let me just the accuracy of which PiFi and the quants are getting it is correct. The Reddit community is large and vast, but I think really to credit you.
when I'm talking about Reddit, I'm talking about the sophisticated Reddit. I'm not on
Oh
Reddit.
yeah,
I only get sent stuff from Justin from Reddit, so that's probably just from PiFi and his quants. I don't have Reddit. I don't go in there too often. I just read the stuff that Justin sends me. Everything else is just kind of my own ideas. But the accuracy at which you can start to predict this stuff is getting almost scary, and with that provides humongous opportunity. So I'm going to go mega long. This is going to be my biggest position, but I'm also my tranches. I'm going to have 3 tranches as well. I'm going to start with my super far IV plays, which will be my 950s. I already have a lot of them because those are also my leaps, but I want to capture as much IV as humanly possible. So let's say I pick up, I don't know, 20 of those 950s. Those are going to be my massive IV. That is going to be me sitting at my computer when I have the time trying to snipe IV plays. So when I open those, I'll let you guys know I have not yet opened them. Then my second tranche will probably be the October 300s to like 200, 2 to 300, because if we do start to run, those deltas will move up. And that's kind of what I like. My last tranche will probably be like maybe September to July, like at the money, maybe 150. Just like I'll only have a few of those, and then I'm gonna also open some BBBY positions just because the way the option chain is looking. Justin was kind of mentioning this to me earlier.
Yeah.
Just looks really really favorable, and it does not seem like BBBY's sophistication is too strong, especially coming into this cycle. So that thing could run. I'm going to go pure IV play on that as well, which will mean I haven't even looked at the super long leaps, but I'll probably just get something, but as far out as I can go, strictly going to try and play the volatility. This is going to be very difficult for someone who is not actively able to sit at their computer and watch these stocks when they're running, because you make the money on the IV bounce, and these IV bounces are such short-lived. I think Justin, you were saying PiFi was mentioning that like IV's up like 40% during these cycles, but if you are going and looking at these intraday, it's not up 40%. If you can snipe the IV like out the breakouts, it's going to be towards like 80 to 100%. And
Yeah.
the gains on that are just ridiculous. If you look at a 40% gain compared to like an 80% gain in IV on like these super long leaps, it's like triple the actual value. So that's where the real gains come from. If you are someone in a fortunate enough position to be able to kind of snipe these.
Yep. And Josh, let me just add this to it. Let me throw this up just for a second, guys. So in case you haven't already seen it, this is basically me trying to figure out like where we're at right now. So you see this coming week, we still have the put slide that appears to be in effect for that. So my guess is that you're going to see the price decline, assuming the puts remain open. So if you have puts, maybe starts exiting the position, over these days, taking profits, whatever, right? And then maybe start buying it around here. Josh, I'm very curious to see how the FOMC presser turns out on the 15th. It's at 2 p.m. Eastern for the market. On another not on another stream, but you mentioned that third time in a stumble. So this is the third consecutive time the Fed raises rates. Curious to see how the market reacts to that. Mannarino thinks that if anyone watches, Gregory Mannarino, his take is the market has already priced in a 50 basis point hike, but if it comes in higher than 50 basis points, the market's not going to like it. But either way, the FOMC pressers, amongst other things, seems like the most interesting thing. So I will probably start entering in earnest the 16th through the 17th, and maybe even the 21st or the 22nd. But if you enter here, the problem with this week is that you're in your coverage zone. Now, granted, when they have to cover, this is T1 and T2, the 21st and the 22nd, but per PiFi, and I think PiFi or someone, I think it was PiFi, reached out to whatever. I guess it's the OCC. Actually, I don't know who it is, but whatever the regulatory, maybe FINRA, maybe it was FINRA, the regulatory agency. And so basically, in addition to the 2 days, they have like 2 bonus days. So this red zone right here, this partial cover zone, this I think is all the time that they theoretically have to cover. And if we see something like in our prior runs, what will happen is that the stock will run and run and run. And depending on where we close right here on the 24th, so this Friday, this will determine, let's say if it keeps running and running and running, and suddenly the option market makers have a GEX problem, then you would see another T1 and T2 on the 27th and the 28th. So you might see another spike. Now, whether that spike creates another spike, which creates another spike, well, maybe not. But the point is that this seems, assuming everything works out the way we think it's going to work out, these 2 days and probably towards the end of not next week, but the week after next, seem to be particularly interesting. PiFi also mentioned that 113 and 108 are our next large support resistances. If we fail beneath that, who knows? I think he drew a line at 80 or so on one of his streams. But again, like I said, if you're looking to enter calls, and this gets back into the strategy for buying calls, if you're going to have, let's say, a large part in one, I shouldn't say that. If one wants to play calls, but with a large percent of those calls being at the money, you want to make sure that you can buy at the money calls without it dropping anymore. Because when like Josh, this, like
You're talking about theta?
not so much theta, but like it's the intrinsic value, I guess, of the call. Because like if you buy an at the money call right now on GME for October or January, you're looking at like 3,000 or 3,500. And that's like with GME trading at 129 if you want a 130 call. That's what it's going to cost or whatever. But if like you buy it now, so you're in a position now, but GME falls down, just numbers on my backside here. If GME falls down to 100, well, your at the money call is now out of the money and you've had to pay for all of that. Now it'll probably run back up, assuming everything functions as it does before, but nonetheless, you're having to pay for that. Conversely, if you entered into like a 950 call, let's say you're paying $350 or whatever, so $350 per call. Yeah, GME, let's say goes down to 100. Yeah, the call is going to go down, but there's so little intrinsic value because everything in those 950 calls for GME would be IV would be an IV space, and same thing with Bed Bath and Beyond. Actually, Josh, we should mention that too with Bobby. I've been picking up this past week. I started picking up $8 calls, and then I started picking up $7 calls, and like I feel like every day I kind of come by a little more like, shit, this stuff stays on sale. Well, maybe I'll just have to put a few more into the basket, and that's what I do. Bobby is interesting because if one has a limited amount of capital to work with, you can have multiple contracts with Bobby. And so the reason I mentioned multiple, suppose let's say just one contract with GME, or let's say you only have like $3,000 to gamble. And just to be clear, this is gambling. This is not investing. But if you have 3K, 3K might buy you one safe, GME contract, but at the same time, it might buy you, depending upon your comfort level, maybe 5 to 10 contracts in Bobby land. And so that way you've got like more bullets to shoot at it. But again, what you are banking on that front is that Bobby will perform similarly to the way GME's performed in the past. And while I think there is precedence to suggest that will be the case, it is by no means guaranteed. So the risk you take on and the lack of the precedent, you don't have to pay nearly as much as you would have to pay for GME. But of course, you have the capital, why not play both? But that's, if you knew the winning lottery numbers, you never have to touch the stuff to begin with. So
let's touch on something else. QT officially, like, they're going to start selling bonds the 16th. The quad witching is the 17th. Then the week after that, we have a long weekend. Then we kind of go into this OPEC cycle. What is going to occur when it will probably be priced into the market that the Fed's going to be selling mortgage-backed securities? They're going to be selling bonds. I mean, it's going to look pretty ugly for the market as a whole. So what will happen to the GME cycle if the stock market's tanking 3, 4, 5% a day? Will we see that humongous negative beta and GME and BBBY can absolutely rip during that time? Or is that going to put a massive damper on this OPEX, as well as XRT going off threshold, off reg show? I mean, those are the main risks right now. What do you think would happen, Justin, if the market's going down 3, 4, 5% the week after the days after the quad witching, and this time during coveraging?
So that's a tricky one for me. Like my attitude is that I am positioned with the expectation that GME is going to go down prior to me going into a position. That's basically saying, this coming week, I think it's going to go down. I think that, I mentioned on the stream today that there's this really weird tendency, like you kind of saw this on Friday, where you saw someone off the Philadelphia exchange buying a bunch of calls that were in the money and then redeeming the calls. The current theory that's been floating around is that this is being done to create volume. So it's basically net neutral. There's no profit. There's no loss, save maybe a few pennies, which is enough to write home about. But the real advantage comes from the ability to generate churn. When you generate churn, you're able to offset or at least ameliorate the effects of an FTD. PIFA did seem to note multiple times, and I get that this is important, but I don't have a deep enough understanding to go into the whys of it's important, is that if you see FTDs on XRT, for example, and that's one thing, because XRT, I think maybe my terminology here is right, but again, don't hold me to it. It's open-ended. So there's theoretically no upward cap on that, or it's much easier to expand a balance sheet in terms of XRT shenanigans. But at the same time, if you're creating FTDs on the underlying GME in this case, which there seems to be evidence to suggest that's going on, that's much more interesting, because I don't think we've seen that since, Josh, help me out here.
I wasn't listening to any of this, but what would be interesting, if there's fail to delivers coming on the GME underline, that would mean that people are borrowing GME and then they cannot deliver it. The problem and the differentiation between XRT and GME is XRT, you can just issue as many shares as you want because it's an ETF. GME, you can't do that. So these people actually have to go and get the shares. If they're failing to deliver, that's a forced coverage instead of XRT, where they can kind of just print the shares. So that would be a much bigger difference. And I would assume every single real short squeeze happens with these fail to delivers, just because.
Yeah, absolutely. In fact, he directly confirmed that. If you guys want, there's I'll put them in the description when we're done here. Actually, Josh, you give me just a second to get my screen set up here.
Was that the DDs that you just wrote?
Yeah. So what I've been trying to do is
put them on our Twitter. I'll link the tweets, but let's just go into some questions and you take this, Justin. If you had a percent chance on MOAS happening, what percent would you give it from a conviction standpoint? There's so many caveats to this. As of right now, I think the probabilities are low. First off, because we don't have the option volume, you really need retail FOMO and people actually exercising those options to drive a humongous MOAS style event, unless, and this is a humongous caveat, unless there's so many forward swaps between counterparties that a small move will just blow up with big banks. Then we could see a MOAS style event with zero option volume. It would just take one of these firms to go bust. What would cause one of those firms to go bust? That's up in the air. It would be one of these cycles that just get bigger and bigger and bigger. But from what the data that we have, which we cannot tell any of these forward swaps or bilateral agreements, you would need extreme option FOMO coming in and people actually exercising those calls.
Yeah, and the one thing I'll say is the only thing I disagree with PiFi on, or when I say disagree, I say this very, very cautiously, is so PiFi accurately notes that they've changed the rules, and these people basically control the game of Calvin ball that they play. So okay, I completely agree with that. No qualms on that front. But I also think back to prior experiences, and one of the other guys I really like to read, who's a bit of a gold bug, but guy's really smart, is Jim Rickards, and he makes a comment and talking about complexity. The point is this: every time they change the rules, every time they put in a new system, every time they enter a new cheat code, every time they go to crime, which isn't going on, but every time they jimmy with regulations or whatever, right? They add a little bit more complexity to the situation. And the thing is that like as long as the expert's model is clever enough to incorporate the data of the whole, they will remain in control. But this is a very old story of humanity. Think back, to biblical times in the Tower of Babel. Like what's going to blow this up, and this is the answer to the MOAS question, there's going to be emergent properties. There's going to be like unforeseen events, and it's going to come out of left field where you're going to have some automated system or some algorithm or whatever, right? That's going to act in a very predictable way from what we can see right now. But this predictable way that this thing's interacting will interact with other things, and the net effect of these interactions or the properties that emerge from these interactions, those will be unpredictable. And that's, I think, what's going to, if MOAS does kick off, that's, I think, going to be part of it, of what's going to kick off MOAS.
I think the most important thing that PiFi never touches on is these these transactions between two parties that are completely untrackable, because I know many people humongously in the hedge fund space, and this is where the majority of their transactions would be done. It would be completely untrackable just between their friends in between different banks and humongous institutions. So if you are one of those institutions, you absolutely have access to this kind of resources that are completely untrackable to anyone. Why would you not use them? And so since we don't have that data, all we have is kind of these XRT, FTD, and just things that we actually can see. PiFi only at least talks about that. I have not yet heard him mention anything on forward swaps or any sort of bilateral agreements. So without that information, we have no clue how big MOAS could get or what the percent of MOAS is. But with the data that we have, the chances of MOAS right now are very low. Unless, let's say GME goes on to reg show list and humongous institutional buy-in comes in, or these cycles continue for, let's say, a few months, and every single cycle just gets bigger and bigger, then it's going to get humongous institutional people looking at it, just because of the sheer quantity of there's actually an opportunity to make money here. And if there's an opportunity to make money with extreme predictability, people are going to do it, and that will just drive each cycle bigger and bigger.
Yeah, and Josh, let me just touch on one more thing in here. Here's a good example of with like emergent properties. Superstonk, they continually talk about reverse repo, and like here's the answer. This is my personal take on reverse repo. Like, I suspect that it's not that, oh my God, reverse repo is going up because of GME shenanigans. Like, no. I doubt that's the case at all. But I do think that RRP going up is indicative of problems that are lurking in the murky depths of the financial system. I might not look, if you're standing on a boat or whatever, right, in the cold Atlantic Ocean, you stare down into the icy depths of the water or whatever, right? You don't know what's down there. There's 5,000 feet of water between you and the ocean floor. There's monsters, creatures, whatever, right? You just don't know what's down there. But every now and then you can kind of see like a ripple, and maybe it's like a whale swimming by. You can't see the whale, but you can see that something really, really big is creating these very, gentle waves that ripple out, and you're kind of awestruck by the size of this. That's what I think RRP is indicative of. It's not like, oh my God, this is a thing, but rather it's just one more of these things. As I'm saying, where there's smoke, there's fire, and this is one of those things I think that shows that there are issues, some of which we know, and probably many more that we don't know, that suggests the financial system that we have right now is much more tenuously perched than we might otherwise believe. So, anyways, I do think that RRP will play a part of it, but not nearly and nowhere near to the extent that I kind of get as the zeitgeist from like Superstock and other things. I mean, keep an eye on it or whatever. It's just like the borrow rate or whatever, right? The fact that the borrow rate remains high, that's interesting, but I don't necessarily put much value in the Ortex stat. I'm more
I
curious.
think the borrow rate's much different than RRP because the borrow rate's actually directly implementing GME.
Oh, yeah.
RRP's not. So let's go on to the next one. How long can indexes continue to lose if everyone is making money on these cycles, Justin?
Well, so this is one of the weird things. Like right now, you have this autopilot problem in the market. So if you've watched us long enough, Josh and I, we come from the macro world, which is kind of like, like very, very high level versus like, zeroing in on stuff. And so you have this passive investment problem. We have a lot of people think like the boomers, think the Gen Xers or whatever, right? And I guess maybe, the older millennials, and they have to invest their 401ks and they have very limited choices, which is ridiculous in the first place, but people have accepted it because they don't know any better. Anyways, the point is that like you have all this passive investing that's going on. The passive investment in these ETFs basically creates an automatic bid in the system. And so to answer your question of like, how does this go on? Well, sooner or later, people are going to have to demand like, listen, my retirement money is my retirement money. It's not yours. And I will do with it what I damn well please. And sure, I might invest in a passive ETF, but maybe I want to invest in real estate. I want to do individual equities or whatever, right? But as long as people invest passively, you've got this autopilot problem because it's like, Josh, you're better at this than I am. Like, let me think about this.
Here, repeat it. Sorry, I was just reading.
Yeah. So like, here's what I'm trying to say. It's like, this is back to the complexity and the emergent properties function. Like if everyone's invested passively, then you're trusting the passive
flows.
Yeah, but the thing is, the reason people are in passive flows is because if they're going in with their retirement, which is probably the vast, if it's not the majority, it's probably the plurality of what's out there. When you have all this passive, like the computer will just automatically buy and automatically sell. Think back to what happened. What was it? 4 weeks ago? 6 weeks ago?
Every dollar for passive flows, it is basically people dumping money into their 401k. It goes into all these ETFs. Every single dollar that comes in, they buy. Every single dollar that's get taken out, they sell. They don't care about fundamentals. They don't even look at it. It's only every inflow buy, every outflow sell. So that's all. That is what these passive flows are, just dumping money into this because every single month they're just forced to. It doesn't matter about anything else.
And let me just add one other thing to that. It's not so much, and the other thing too is that like the people like who are putting vast sums of their retirement funds in this stuff, like it's not that they don't care, but like there's no like oversight that they're demanding on the passive funds, and so like there's no one of the common themes we've seen over and over and over again. Like Josh and I oftentimes talk about what will constrain the balance sheets. That's how Josh and I would approach this situation. But the same thing goes true with this. Is like if people aren't going to demand or like take the time to like monitor the people they've entrusted with their assets. Even in a passive standpoint, like don't whine when you have these passive, automatic, idiot-driven things where the computer did exactly what it was programmed to do, but it did it at the most inopportune time because that's just what the logic said. Again, not to harp on this, but exhibit one of that is long-term capital management. Where you had something blow up, but I talk about
how low can the prices drop before OPEX? I'm hoping very, very low. Like ideally, I would want to see sub 100, but the key levels would really be 113, 108. Then if we drop below that, we could get pretty low. It really depends on what happens in the market. I'm pretty bearish going into this next week. I think Monday, Tuesday, Wednesday could be pretty low, but I think once we see that 50 basis point hike, maybe we start to trickle back up the rest of the week. I honestly, that would just be a pure guess of mine. Personally, I am positioned for a downward move going into the first half of the week. I don't know. I don't know what will happen, but I'm hoping that we get pretty low, mainly because I just want to buy in at the most opportunistic time, and I'm going to buy in probably every single day next week just to get the average cost and kind of see what happens from there.
Yeah, and I don't know if you can see my screen here. Okay, here we go. So this is Market Chameleon, and so like I very much like them, but of course do your own thing. So this is Friday. You had some positive. How PiFi said on the stream. We probably would see maybe some small GEX or gamma covering on Monday, but don't expect to be long lived. But let me scroll down a little bit. You see this right here? This is the past week or whatever, right? And I suspect again, this is hard for me to do because market mechanics is not my bag, but when all this is net, green is net calls, red is or green are calls being bought, and red are puts being bought, at least as I poorly understand it. But you have all of this bearish sentiment that's gone into the thing, and I suspect this is the creation and the build out of the gamma ramp. If you remember PiFi stream, not from this week, but a weekend ago on Sunday or whatever, he was talking about how they were hollowing out, how they were establishing this gamma slide, and it was in very advantageous terms because GME was performing very well. So you answer the question of how low can this go? Well, I would say number one, look what PiFi said. So you've got 113 and 108 are the next big resistance levels. And then beyond that, it's anyone's guess. But as far as like entries, again, I can't tell you what to do, but I have been buying like pretty much every day, like maybe 5 to 10 calls on Bobby, just depending upon whatever I'm kind of in the mood for. And then I kind of want to see what happens with GME. I do expect GME to go down. I'm positioned for GME to go down. And so I suspect that probably beneath 110, I'll start closing out my bearish position on GME and then start moving into a more bullish position. But I will definitely do that if I expect, especially if I expect GME to go down. I will definitely do that by buying my probably out of the money calls first, because if GME does continue to go down, those are going to be those will be the calls I believe that will be affected the less by. I mean, they will be affected. Don't be wrong, but versus buying like a very expensive at the money contract.
Something that I actually think is very bullish for this upcoming cycle is how strong everything remains. I mean, we see these, as Justin was just showing us, these humongous red flags that we see. I mean, humongous put positions are coming in, but we see the price of GME staying relatively extremely strong, especially on the backdrop of Friday's just extremely bloody market. GME was flat on the day. That is very bullish.
No.
That there's humongous interest coming in.
Yeah, actually, Josh, I can talk about that. That was so we talked a lot about. I don't have a market chameleon, but that was PiFi commented that looked like a lot of orders were coming in off the Philadelphia exchange. And again, this is like doing the churn or whatever, right? And so he said, like, listen, as active funds are selling off as the market goes down, it makes it really, it's a very good sweet spot because you need to generate churn, declare it FTDs, where you buy and exercise calls. And while that does provide a floor in the price against, the downward pressure of a general market sell-off, it's very easy to generate turn. But my point is that when you look at the positive call pressure that came in on Friday, as I understand it, don't think of that as being, retail wants to FOMO in. Think of that more so as people are trying to, again, like ameliorate, failure to delivers on GME, which is interesting in its own thing. We talked about that before, but don't expect that to, or that's probably not going to be a sustained trend going forward.
How far out are we going to buy the calls? I'm going to go October, January, and maybe, I don't even know. I haven't looked at the September option chain at all. If I can't get anything in September, July, we kind of touched on that earlier though, where we were really talking about what we plan on doing. We will make a full video once we enter every single position, because we don't know exactly what positions we're going to enter, because we don't know what next week is going to uphold. But we will show you guys absolutely everything that we do when we do it. It's great to see you too, Phil. Girk's sister, hello. MOAB won't happen unless retail piles into options. SS absolutely obliterated that opportunity. Those of us who play understand the back loop. Girk's sister. We agree with that, of course, unless we do have these swaps that we can't track. But something that I would note is interesting is I hope these cycles continue forever. I mean, ideally, I would never want MOAS to happen. I would want these cycles every single quarter. If we can accurately predict $100 to $200 price move, I mean, just let's just say you can 10x your money every single quarter. What would happen? Let's say you drop 10,000, then you have 100,000, then you have 1 million, then you have 10 million, then you have 100 million in just a few quarters. If everyone was doing that, you would never want MOAS. You literally have an infinite money machine. Of course, it's not going to happen like that, because eventually something is going to have to stop. But the way that things are going, that is what it looks like. So
yeah. And the other thing too is that even Girk mentioned that one of the interesting things this time around is you see retail starting to have more and more of an appetite for options, and it gets back into like the first time I really started playing with options with GME was like summer, and like just to be clear, I had no clue what I was doing, and let's be perfectly frank, I still have no clue what I'm doing. So let's be clear on that front. But when November happened, I didn't get burned in November. Actually, I was driving over to Phoenix to meet up with Josh at the time or whatever, right? And so like I was able to get that first, I think, pre-run before Frex Day, and then like there's really shitty internet in New Mexico and Arizona when you're on 10, but whatever, that's not important. The takeaway though is that like I didn't get burned, but I know many people did get burned in that front, and that really soured people from options. But the good news from all of this is that you are seeing more and more retail like slowly approach it cautiously. And again, like a huge hat tip to Girk and everyone who's there, because like that dude, I mean, like day in and day out, unless his like elevator's like blowing up or whatever, or he has like those murder hornets in his apartment. Like the guy's there, streaming, answering questions, telling people what's going on, and like that's that's worth something. So well, we will see what happens, but I think it is important to note that retail is starting to get back into calls. So heads up.
Yeah, the Dixie at 104 is not good for anything, especially as we were alluding to complexity. Complexity does not like the dollar. Like that, when the dollar goes up, it sucks everything out of it. Just like Brent Johnson, it's like a milkshake where when the dollar is rising, absolutely everything is going to fall with it. And especially if with this credit, it would not be good. And right along the same time, the Fed's going to be selling bonds and mortgage-backed securities. It might be a tough time for the market to absorb all of that excess liquidity. So I think it could get pretty ugly in the credit markets. If that does happen, that's when we really could start to see some crash-like movements. Yep, we put our Twitter Brexit. Moas, when GME gets into the S&P 500, I don't know. I don't know when or if they would ever get into the S&P 500. How much money does GameStop pay Computershares monthly for each and every direct register account? I don't know.
Oh, not nearly as much as Citadel pays us for shilling. So just so you know, we make more.
I've yet to receive my check, but I would happily accept it. I'd like to get a new microphone, maybe a camera. Did you guys see how much credit you get for selling BBY $7 cash secured put leaps? You can essentially pay up to $8 leap position with very little capital tied up.
Ooh, really? Let me take a look at that. Hold on.
Yeah, you check that up. It's tough for me to talk right now. My lips are a little swollen. I got my wisdom teeth taken out. It was not the Wendy's dumpster. I will repeat again.
It was the Burger King. It was the Burger King dumpster.
They're basically swaps. You basically go into the repo market and do a bilateral swap between two parties. So I've used this example a bunch, but I'll use it again. One of my great, well, I won't call him great, but I have a call with him every 3 weeks, and I think of him kind of like a mentor. He's an older fella, but him and they ran a humongous hedge fund. I mean, they had so assets under management, they had 50 billion long, 50 billion short, and then 100 billion of these agreements between parties. But it's basically just leverage. So whatever they had on their balance sheet, if they had 100 billion, they would lever up another 100 billion. But that other 100 billion was completely untrackable. It's in the ghost. There's nothing. It's just agreements between parties that you guys settle at the end of the day. So that was prior to probably in the 90s to early thousands. So if that's what was happening then, you can expect similar things to be happening now. Let's say Citadel has $100 billion of assets under management. I can assure you that they will have another 100 billion that they are using as these bilateral agreements between different parties, just to keep it very simple. But that it is it's completely untrackable. You don't report it on your balance sheet. It is just agreements. It's just, if me and Justin, if we made a steak dinner bet, if MOS was going to happen in February and it didn't, it's up to us to uphold that agreement.
Yeah, just a side note. Everyone here goes to Fleming's or whatever, right? But they're on Uber Eats or whatever, right? And they have a really good tomahawk, which is just a big ass ribeye. And every now and then, like, I'll order one, and like I've started getting like thank you cards from Fleming's, and so I feel like maybe I'm giving them too much business. I do that just to piss off Klaus Schwab. Okay, so here we are.
What you pull up mine.
Oh, here we go. Yeah, right. So show the one. Okay, so right here or whatever, right? So it looks like what you could sell like a 7 or 8. So yeah, actually it's not bad. So you get back 346. You tie up $80. What's that? That's like a third? No. That's like a quarter. That's like a quarter of what you're taking up. Yeah, no, that is interesting. Look at that pile up right there. You see that? 208, 788. I don't know. My screen's big enough to read. So, but yeah, good call.
Justin, any thoughts on Roblox? I have none. It's 200% for interest. I haven't looked at it, nor do I plan on looking at it.
Yeah. No, so here's my problem. It's like when it comes to the markets, like I do not trust the markets at all. Like I'll play GME, I'll play Bobby, and I'll play some silver miners because I have a very, very small edge there. Beyond that, like I'm a real estate guy. Like I do not like the market. I realize that like you have to run with wolves, and I don't know what lurks, in the forest here or whatever, right? But I beyond just my very, very narrow things, I want very little to do with it. But that's just me. I mean, Josh is the one you want to talk to for that stuff.
I don't have an edge there. Hey, Josh, you're saying that 140% on the JN 950s are possibly going to shoot up. How much? I was talking about IV. 140% is probably unlikely, but we could see 100%. I mean, easily 70 to 80% IV spike is not just reasonable, but that happens with pretty frequency. When we break out of these resistance, IV just shoots up on those leaps. But the problem is it only shoots up for minutes at most. So you really have to be on top of your game and ready to sell them. Yeah, Justin, just play around with that for a quick second.
Okay, yeah, here.
Get the options. So, if you go to those 950s, I'll kind of talk over it while you're doing it. Right now, they're pretty cheap. They're $3.20, and with that, just let's say we go to 150 to 250 for the actual stock price.
Yeah, or whatever. So let's say the stock's so right now the stock's trading at 128. Let's just say you go up. Let's say just to 3. So let's double that. So that takes you to let's see. Yeah,
for the cycle. Let's say we go to 150 to 250. Like you'll see, even though there's a 950 strike, if you're playing it as an IV jump, you're actually going to make astronomical gains. With no IV, you make decent money. If we go to like 200, you can make like 200-300%. But
yeah. Which is IV in itself, but like when you change, and this is option profit calculator, by the way, but if you change this up, and this is why, like I said, like if you can get this, watch the green change on that front. You see that?
Green, like the amount that you're making is retarded, frankly. Like, and this will, when you see these 100% IV spikes, it will be such short-lived. Let's say you did put that $10. I mean, that you buy those 10 contracts. What are you actually making? Go to like the $200. Let's say we break out a channel and we run to 200 after like a gap and fill. What is that? 8,000, 7,000%? That is just ridiculous. You're walking like, well, that's going to be in June if that does happen.
Yeah, so it's going to be.
What is that? You're going to make 8,000%, which is not too shabby. You buy 20 of those, it's decent returns. I mean, like beyond easy.
Yeah, and let me throw one other thing too. This is the way that I kind of like think about this, and like this shows you how unsophisticated I am. But just let me walk you through something of this is how I mull it over. So if you look to my screen, like I put in, let's say you buy 3 contracts. You've got with the price at the close of Friday yesterday or whatever, right? Basically about $1,000, okay? But you've got 3 contracts. And so what you can do is, okay, well, listen, if GME runs up to, let's say, where are we at right now? We're at like 130. Give me just a second here. So let's say GME runs up, and let's say there's no spike in IV or whatever, right? I mean, I think there would be. Let's just be as conservative as we possibly can. Like what you might say is that if GME were to do like a run, slowly or whatever, again, I don't think it's going to be slow, but let's say if GME gets up to, 168 or 172, well, if you take one of your 3 contracts, oh, shoot, I'm doing my calculation wrong. What I'm trying to say is that this is why you want to do this, and don't do it on stream because it's hard to do in real time. But what you would do is, okay, well, listen, I'll let one of my contracts go early on, but by letting it go early on, I'll claw back my basis. I'll have no more money left in the play, and then the other 2 you can be a lot more aggressive on because you've gotten back your capital. When we went to PiFi side today, number 1, manage your risk, and then number 2, be greedy with or then number 2, be worry about profits. Don't do it the other way around. So conceptually, that's kind of how I think about it. Is that once I can pull back my basis, then I'm much more keen to let it rip. And the other thing too is that now that what's the target exit is like you always want to keep a track of what your gamma max is. And in the past, we've run up about 30%. Is that what PiFi said? There's a 30% plus of what we run up. And they also talk about, if you go back to those 2 linked posts on Reddit, there's several times he's answered the questions of when you see gamma neutral going crazy, that suggests that they're doing their entropy nonsense, and that probably suggests the price is about to fall. So if you know that going into it, you can exercise extreme caution and make sure you've got really tight stops set in. So if the market does move against you, you get out.
Considering that ETFs are literally the infinite liquidity engines for individual stocks, it's actually the ETFs that are losing the value the most. PiFi mentioned this a few times.
Yeah, and Phil, or Stephen, one other thing to note on that front is that, like, I agree with that statement, but don't forget to add this part in as well. Like, they're the infinite liquidity engine, but the engine has to be cycled off and then cycled back on every, let's say, quarter or whatever, right? And like, I still have a hard time understanding this. Like, I get the fact that the reason they don't want to hold obligations over, that is, let's say, XRT obligations over quad witching or whatever, right? Is because if the ETF announces a dividend, well, the shorts are on the hook for the dividend. They don't have to deal with that or whatever, right? So, okay, so I get that. But I would just note that there was a time frame. I think I sent this to Josh the other day. Like, I don't think that, June 17th is going to be a margin call, but rather I kind of think about it. It's like a pre-agreed margin check in text, it's kind of how I think about it. And, yeah, no, interesting. Yeah.
But best strategy for near dated expirations. I personally don't go near dated because theta crushes you.
Yeah.
No one ever regrets buying time. Like maybe it costs you 20% more to go out to September or August, but I do not think you would regret that. But if you do want to do that, I would go July 15th. But you have to make sure that you have like a really solid exit strategy if you are going that close. Justin's gotten fried on this more times than anyone that I know because he would just throw money at it, and I'm like, buddy, like that's not the way it works. And I mean, like,
I just love red. I love the red. So
laughing hurts so bad. Please no.
Oh, sorry. Yeah, my bad.
All right, what is the damaging time for hedge funds to announce the shared divvy before OPEX or during? Any insight on that?
Well, so Deez, I think what you're trying to ask the question on is that what is the most damning time for GameStop to announce a share dividend, right? I think that's that's the question. That I don't know. Like, so that's a market mechanics question again. Like, PieFi's, the boss on that one. My guess is no, I shouldn't even guess. Like, Deez, like I wish I had a good answer to give you. I'm sorry, man. I just don't.
Before, because that's going to drive FOMO going into it. But that's about the only edge I have, and because the main point of the shared divvy is the FOMO that it builds around it, and the amount of interest that it kind of all eyes on it.
Yeah, and Josh, let me just pull this one for a second right here. When it comes to these near dated contracts, like, be really, really careful with this. You don't know if they have any other tricks. You don't know if they have anything up their sleeve, and like I would. Just personally, I think an abundance of caution, as I would realize by not being shy about paying for theta, so buying very long dated contracts. I mean, that's me speaking for me. I mean, you do you, but just I'd rather have and not need than need and not have. So.
I need to get into this because it's hilarious. I fell asleep this afternoon watching a mad video. I had a dream where Josh was going to marry Luke, and Josh had the longest mullet I've ever seen, and hipster George Costanza glasses. That is hilarious. I may have to marry Luke just for legal reasons because he came here from Australia and he's on a very tight visa where they're not going to let him back in the U.S. unless he finds still getting married. If anyone is looking for a marriage, he's a great guy. I know girls watch our stream, so this is probably about pointless. I'm probably the last chance he has of getting married in 30 days.
Wait, girls watch this? Like, is there nothing else to do? Like, by accident?
Besides my mother, there's nobody. But I don't think she's going to marry a 25-year-old young kid. Scared Lexinus warned of a rug pull. My best puts are dated July 15th. Girk seems guarded too. He said today to be risk adverse first and seek profits second.
Well, hold on, a second. Yeah, no, Rocket, excellent thing. I caught on that too today. Yeah, you want to take care of your risk first and then profit second. But as a follow up to that, like I heard that in context of management of this coming week, and so that's one of those reasons why, like I said, I still have some puts that are have done pretty well on GME, as I expected to go down further, and then over this coming week, I anticipate closing those out and then rotating into my bullish position on GME. But that was my takeaway from that. And like that's one of those reasons too, where like I said, if you want to buy at the money GME calls, which I do think that is something I definitely plan on doing, but because they're at the money versus these 950s or whatever, right? I really want to make sure I get a good entry point on that, because a lot of the contract value is going to be the intrinsic value versus the
something else that Justin does that really gets me angry is he would overbid for these contracts, and when I tell you that gets me so angry, because I will never overbid unless I really if I have to get filled at this instant. But Justin's like, oh yeah, like I want to buy leaps and I want to overpay for them. I'm like do you have an actual issue in your brain? So please do not overbid for contracts. But basically, if you're going for the bid ask, like he would go for the ask, like for no reason either.
So, I've gotten better. To be fair, I've gotten better.
Please don't jinx anything. I am way too long gold.
Oh, actually, hold on. Let me go back to Gabriel. So, Gabriel, one of the things that I started doing a long time ago is that I will use leverage, and I try to become my own bank. Taking a page from Gregory Mannarino's book, And like I view like buying metals, and I don't mean buying GLD or even the Sprott, ETFs or whatever, right? I mean like actually like taking physical delivery of your own metal as like saving your financial gains, like going through a financial checkpoint. And if you want to borrow against it, you can. And so like I've been mulling over like let's say like you see like a run, and maybe this is a question not for this stream, but put it plant the seed for the futures. Let's say like 3 or 4 weeks from now, we're all fortunate enough, and it runs, everyone's able to get out, attendees are had by everyone or whatever, right? I think I would probably take the majority of that, buy metals, ship the metals off to there's a facility that I use, and then if I wanted cash, so let's say you wanted to go back, let's say we see let's say things look good to a July run, I would send it over there, and then I would consider borrowing against that to draw back the cash if I wanted to play the cycle. But I really like the idea of buying metals. Like metals are just on such a bargain right now because nobody likes them, which is a huge plus.
Me too, Stefan. Oh, the irony. GME direct registered shares, more volatile GME cycles. I'm 100% pro DRS, just not for the same reasons. Yeah, me too, man. Me too. It makes everything more volatile. But I'm an IV trader. I mean, this is why I love GameStop. I was never interested in GameStop until I realized the intrinsic value that that implied volatility had on it.
Yeah, let me just defend, like, the super strong doing the DRS thing. Like, you see people who are trying to climb to the light, right? So I give credit where credit's due. I sense people are coming from, like, an honest, and albeit it might be self-motivated, but, there's some truth in this regard. There's outside the scope of the stream, you can make a philosophical argument that where we're at right now is because there has been lies and deception. There's very little truth in the system. The Bitcoin guys, even though I disagree with them, they get that part right. There's no truth in the system. So in terms of that, like I say more power to them. And like if people want to DRS, by all means do it. Options aren't for everyone, but just understand what you're getting into and try to. As Mike Maloney says, the only financial advice that he does give out, and I will do the same, is that it is never wrong to try to improve your education. Like always try to do that. And if DRSing is what you want to do, at least try to understand like the mechanics and the why beyond it versus just the off the shelf regurgitation of what people
also
see.
Guys, I might have some good news. I am thinking about chopping off the hair for this cycle just because I need all the luck that I can get. So I might go bald ski for the cycle. If so, I'm expecting PayPals from every single one of you after we see MOAS. What is a good strategy if you have $1,000 to play for this cycle? That's a great question. So, if I
here, Josh, I'll get some options and set up.
But here's what I would do. It depends first off how much time you have. I would, if I had $1,000, my goal would be to turn that into as much as possible. And I would first look at these 950 because they're the cheapest. Let's say GME gets crushed and you can buy these 950s like 280. I would probably just get as many 950s as I could because that's going to be your biggest bang for your buck. And only if you can provide the biggest IV spike as humanly possible. If you are very active and can kind of watch this daily, let's say you're in PiFi stream and you're watching IV and you can kind of snipe out of these calls with pretty good accuracy, first off, you're going to have multiple calls to play with. And that's very big. Something that I would always do is I'd pick up 1 or 2 calls and then it's very difficult to actually get out the position. So let's say you can pick up 3 or 4 because they get really cheap. I would just go straight 950s just because that's going to be your most leveraged. And if I only had $1,000 to play in this cycle, my goal would be to make as much money as possible because in reality, your goal should be able to make that as much as possible to then profit from the next cycle.
Yeah. So let me go through. So let me be really, really clear on this front. Like this is, if you ask the question, what would Justin do if Justin only had $1,000 to invest? This is what I would do.
No, it's not investing. And as Justin is just saying, it's not investing. This is pure speculation. I don't call it gambling because I think there's a higher than 50% probability of something like this playing out.
Oh yeah, and like I said, if you can count cards or whatever, give yourself an edge over the house. But so here's what I mean by this or whatever, right? So here's what I've done. I've got so BBBY is at $7 right now. So like $8 is basically out the money, okay? And 2 of those calls, and all these contracts are for January of 2023. So I would like to think that there's plenty of time on this. But anyways, you basically take half your capital and you put it against the safest forgive me for saying that, but the safest call for you. So you've got two contracts right there. Then let's say you buy another two calls that are like, and I just picked 20. I mean, without looking at the option chain, I assume there's a fair amount of open interest at 20, so you'll have liquidity there. But again, two calls will run you that. So you've got $550 and 260. So that's what, about $800 or so of your capital. So you've got that. There. And then for your speculative position right here, you've got your 5 contracts, and these are the $80 ones. So even if BBBY doesn't run up to $80, if there's an IV spike, these things are going to really, cover the day on that. But, if you want to see the numbers or whatever, right? Let's say Bobby runs up to, Josh, what did it run to in the last one? Like 30? No, it's 26. It ran up to 26. So just say it runs up to 25 or whatever, right? That's a relatively decent return right there. So, I mean, you can close it out. And if you do see
Justin, my goal would not be through BBBY just because we don't have as much accuracy on the cycles. That is only saying that if GME runs BBBY, we'll run with it. So I don't like that as much because we do have much more data on GME. That's what I would stick to. Maybe pick up one of those GME calls. I mean BBBY, just because there's more leveraged and they're way cheaper. $1,000 is tough because in the stock market you almost need money to make money. So ideally, you get super lucky and you do 10x this cycle. If that happens, then you have $10,000 to play with the next cycle. That's when you have real money to actually position. But it is tough with $1,000. Truthfully speaking, that's just kind of the sad truth of the stock market.
Yeah, but I would even give like a hat tip to Bobby, right? Like, Josh, you're absolutely correct. What you lose in terms of what we assume to be the predictability of the GME cycle, you gain because you don't have those massive fat premiums for Bobby. So, I mean,
they're cheap. Like, I mean, the BBBY options, there's like no IV on them right now. So those things are relatively cheap, especially if you are someone who thinks BBY is going to run with GME. I will probably build for every 8 GME calls I buy. I will probably buy 1 BBBY just because there is some extreme asymmetry. I might just sauce quite a few just for the lulls. Justin, any word from Melvin lately? I know they're going bust or they're closing down shop. I don't exactly know everything, the ins and outs of them. For me, I'm not too concerned. Like, they probably already passed off their obligations or closed them. They're kind of out of my limelight. Justin, when you're in real estate, he's not buying REITs. He's a multifamily guy.
Yeah. No. Like I want very little. Like I cannot emphasize enough like my disdain of the market. Like I want as little to do with it as possible.
Going for cash flow, kind of a syndication type of group he has going.
Yeah, like with real estate, I can go out, I can touch it, I can manage it. Like I can pay people to manage it for me. Like I just.
Josh, do you have market orders when you're selling such extreme IV plays? PieFi mentioned something like that on today's member stream and didn't understand why. I would have some market orders, but mainly I would just be live in the market watching this happen. If I don't have the time, something that I've done in the past is put in extremely high limit orders because when IV jumps, it just explodes the value of the option. And I'll try and snipe some of those with some of my contracts. But usually if I'm watching it and IV is just exploding in value, I'll start to sell some of them, market orders. I'll put some above the limit just to try and snipe something in case it does get filled, and quite a few they will get filled when IV's spiking at such extreme rates and FOMO is really starting to build. That's pretty much the way I do it. But these happen very, very quickly. These IV spikes are happening in minutes, so you really have to be on top of your game. But they happen pretty often intraday because these run-ups they're pretty frequent. If you're watching GME on the minute chart, we'll have like humongous breakouts where IV spikes to like 70% and your options explode in value. But then you refresh your page and even when GME just stagnates and goes down slightly, the value of those contracts just get obliterated by like 30% compared to where they were. But,
and the way that
30, 40 minutes later, the same thing happens. And sometimes the stock price will be higher than it was a few minutes before, but IV will be lower. And that's why it's so difficult. And it's why PieFi kind of says this is not for beginners. That's why you like IV plays are much more difficult to manage, but if you can snipe them at good times, you will make just retarded money.
Yeah, and lastly, consider this too. Like when you have a market order, you're guaranteed execution. When you have a limit order, you're guaranteed price. And so if things are going, haywire or whatever, right, you probably want to be guaranteed execution, even if you have to take a suboptimal price, because at least you get filled. So,
ETF, infinite liquidity with a bandwidth. What do ETF balance every 90 days?
Don't know. I mean, like market mechanics, PieFi, ask him. But there's some regular thing that runs on about a quarter. So let me I would guess yes for that one.
What are the signs you look for a rug pull this cycle? Justin, do you have anything?
Yeah. So what you want to do is let me just read this because I put this thing here. Let me just put a link in right now too, so you can view this on your own for that. But it's gamma neutral goes crazy when they shed their entropy swaps. This is historically aligned with the peak of large prior runs. So what you want to do right here is you want to pay attention to whatever the gamma max is. So whenever we go above gamma max, exercise an abundance of caution to the greatest extent that you possibly can. And then keep a really close eye on gamma. If you have an access to gamma neutral, follow that. If you're wondering, where the hell do I find these numbers? PyPhi puts it up at the beginning of his stream, and there's others, that put it up regularly too. But I'd keep a very close eye on this thing right here. And if you go back, and this link is one I just put in the comments. If you watch that, that's probably a much better description straight from PyPhi himself, talking about how to think about it. But that's I think the general concept. Above gamma max, and when you see gamma neutral going crazy, make sure you've got your risk really tight under control, really tight.
Oh shit, dude! It's already been an hour. All right, we're gonna try and bang a few more of these out.
Let's see. Constant said, let's see. What has been your experience selling these contracts and volatility spikes? How close to the bid? I got out. So I actually had this shows you how inexperienced I was, but I had a huge buildup of April. What was it? It was April 5/10, right?
On June 17th.
Yeah, and I was down
massive, like six digit positions in these.
Oh yeah, I was down a quarter. I was down a quarter on those, and I was able to get out thanks to the IV spike. That was just
on a profit too. But it was strictly on the IV spike, and I mean, like it was pretty magnificent, because if not, Justin would have been behind that Wendy's just like I was yesterday, doing things he never would have imagined.
Yeah. But
I really like this question. Do you guys plan on playing the downside of the OPEX? What would your strategy be for puts? First off, it really depends on what this OPEX looks like. I mean, because we have absolutely no clue until we get into it. Is it going to be humongous? Will we just run to 200? If we run to 200, we peak for a day, then we start to run down, I will absolutely pick up puts, because people call us shills for trying to trade around this. I don't care. Mike, if your only goal is to make money, then it does not matter what someone's calling you a shill for playing the same game as the hedge funds. The hedge funds make money. I don't know about you guys, but I also like to make money. So if you see a situation, I will follow the hedge funds that are manipulating this and go the exact same way as them, because at the end of the day, if everyone's doing this, the cycles will get bigger and bigger until they blow up. And when you have more capital to play with, you have a lot higher chance of executing a lot of these calls. And if let's say we play 5 of these cycles with extreme accuracy, then you can start to exercise these calls and just get more shares than anyone on Superstonk could dream.
Yeah. And if I was a hedge fund, or if I was someone if I was a sophisticated market player, the last thing I would want is retail getting aboard this, this gravy train. And more importantly, if I had the resources to shape perception, which I probably would, if I can control regulators, I can probably control the perception on Reddit and other places too. I would want to poison the well to the largest extent I possibly could when it comes to options. But as far as exiting out, and kind of like to the next question right here, do you guys plan on playing the downside as well? I would just say, well, covered calls are your answer on that. Assume you've got 100 shares to play on. So like if you start writing covered calls, if you can get that second peak when we spike for the second time, you sell calls when IV is really high, and you just basically write it down. That's an attractive thing to do. Of course, the downside from that is you have to have at least 100 shares in order to do that. But again, that's how I would play the downside myself.
Shit, let's find one more question, then we'll head off. This has been the most lively stream I think we've had yet, or we just had we spent more time per question.
Oh yeah, I did see that. Yeah, yeah, I was watching that earlier. I forgot to charge my car last night, so I did have to go to the HEB here and get a little bit of juicy juice. Bullish. Yeah, me too.
I was thinking about it today just because I was out walking with my luscious locks just flopping across, and I was thinking it would be a great time to just chop everything off, just for the summer.
Hold on.
And mainly for the June OPEX. I bought just.
I don't know where. Yeah, where the shitty wig.
As you can tell, it's probably $7 plus shipping, and that's where they get you on the shipping. All right, guys. like we try to only go an hour just because I was supposed to hit the gym. So thank you guys very much. We will, if there's, we'll try and find some more questions and answer them in one of our next videos. Thank you very much for the support. Anything else, Justin?
No, just I would say a big, thank you again to PyFi and all the guys there, because I mean, like, all that we really do is just, we try to, add some context to it and just, say, hey.
Justin's pretty active on PyFis. I don't really watch PyFi too much just because I just, it's not my thing to, I like to kind of get my own thoughts and then kind of work off them. I love hearing Justin because I know that he's getting to the source straight from PyFi, but I like to kind of come to my own conclusions, or else I'll just be regurgitating someone else's information. I've seen myself doing this way too many times, especially in the macro view. I could tell you every single person's theory on inflation, but I wouldn't be able to tell you mine because I wouldn't have had a base case. I would tell you what Lynn Alden thought, what Luke Roman thought, what Brent Johnson thought, what Jeff Snyder thought, what George Gaiman thought, but I couldn't tell you what I thought because I didn't have any thoughts, because I could just regurgitate each of their. Yeah. He cuts it. We know as well. Our friend All Nighter Hider did arrive in Alaska, and he told me he has his burner phone. So if MOAS does start, I'll call him up, and we will. That we could have all the stars aligning, but I don't know. We'll see you guys in the next one. Thanks for everyone hanging out with us.
Yeah, take care, guys.